right. Good morning. Good morning. I'm Tim Judge, founder of Home Search TV. Today we have the Adwar team hosting Mortgage Matters with some very special guests. But our host for this morning, Todd Adwar. Todd, how you doing?
I'm doing great, and welcome to everybody to Mortgage Matters. I'm Todd Adwar with the Adwar team, and today our show is going to be on fix and flips designed to help investors buy homes. And we all watch these TV shows and we think, wow, it looks really easy, but you really need some pros on it. And today we have Peter Goodman from Berger, Fishoff, Schumer, Wexler, and Goodman from New York City. He's an attorney in New York City and on Long Island, and he's going to be joining us. And hopefully we have Bruce Lawner from Bayport Funding who will join us and talk about the fix and flips as well. So let's start with you, Peter. Can you tell everybody how long you've been a real estate attorney?
I've been working as a real estate attorney since 1995. And in that time, I've been handling real estate closings, representing banks, buyers, sellers of commercial and residential properties. We also do real estate litigation. So we really go through the gamut of real estate.
So you've seen over the years pretty much every scenario when it comes to fix and flips and when it comes to people investing in properties, correct? Buyer's side, seller's side.
Fix and flips have been going on since the dawn of real estate.
So give me a rough number. How many fix and flips would you say you've been involved with as far as being an attorney?
Hundreds, absolutely hundreds. And it depends. I mean, I've represented the end buyer, who is usually a first-time home buyer buying one of the properties, and I've represented the investor as a buyer who then flips and sells it after they do the rehab. So I've been involved in all facets of that transaction.
Okay. And do you have any recommendations to new investors as far as, contract terms that they should be careful of, what they should look for, when going into contract?
Absolutely. Look, there's lots of practical advice. There's lots of contractual advice. First of all, having an attorney that is experienced in doing these types of transactions clearly is important. But certain things that you should think about when you are buying a fix and flip on the purchase side, especially if you're new. Obviously, I mean, I'm sure you're going to talk about the numbers. That's something that I assume my clients have already worked out. But some of the things, most of the time when you're buying a fix and flip, it's often from either an estate or you're buying it from someone that has had a distressed property, maybe a foreclosure or a short sale, or it's someone that just hasn't been able to keep up the property and is trying to move. So you have to understand who your buyer is, because that might affect the time frame it takes you to get through the closing. And if you have a certain time frame when you're in contract and you need to, let's say, do your construction during the warmer months of the year, you need to be sure you're going to be ready to go. So if you're buying from an estate and the seller doesn't yet have the surrogate court approval, that could be an issue. So you want to make sure that they have the full approval ready to go so they can sell you the property. If not, you could be waiting on a delay, and time is money, as we all know.
So you order title, you have a special program for your title company that you order title immediately. Can you explain that?
We do that whether you're the buyer or seller. And I don't know why people don't do this. It hasn't been common. You order a home inspection where you inspect the home to make sure you know the physical condition of the property. Yeah. People should be ordering a pre-title search to make sure they know the legal condition of the property. Title is the silent killer. A lot of times we'll order a title search, and typically an attorney will order it once they're in contract. It may take 3 weeks to get it. To get the municipal records, it may take 3 to 5 weeks. And by the time they see that and they see all of a sudden there's an old mortgage problem, there's a court order that they need to resolve, there's a lien, there's a judgment, there's a violation. Those things take time to resolve. So if you order the title up front, and as soon as as soon as the deal sheet is prepared and you have a handshake accepted offer, you will get that report a lot quicker. And what we do is we go right to the source, to not just the title company, you're right to the source where they're ordering the searches. So we'll get the abstract and we'll have the report before any title company is going to have the report ready. Because what a title company does is they do the searches, they put together the package to make it nice and pretty. They put together what's called the Schedule B with all the exceptions. And then they send the report to the attorneys. We get that raw data, and then we analyze that raw data to make sure that we resolve problems before they become problems. We spot
Well,
issues.
that makes sense. That makes a lot of sense. Have you run into any, colorful examples of things that have come up, whether they were at contract or at closing, because they didn't do it correctly?
Countless times. And some of the things you need to think about who your seller is. Again, some sellers, they say, okay, I'm selling in the property, I'm just leaving. That's it. I'm taking a suitcase and I'm gone. So if your seller thinks that they're leaving all the furniture there and tons of garbage, and some of these people are hoarders, right? You may be buying from a hoarder. You want to make sure you have an understanding that you're not going to be having to order a huge dumpster to remove all that stuff. So it needs to be in the contract. And I've seen that happen. That has arguments, the seller selling the property, the buyer who's an investor goes to inspect the property before closing, and it's filled with junk. And now you're looking at thousands of dollars in extra expenses. So you would agree that
your clients that do well with the fix and flips all have a plan for construction, whether they have a crew of people that they use, or they know this is going to be their general contractor, or they have that solved first before they start looking at properties. Is that something you recommend?
You don't want to be paying retail on your construction. You want to have your crew. You want to know, some of my clients will make their contractors a partner, so they're not paying the full boat. And of course, I know, with lenders, there are lots of good programs to fix and flips, which I'm sure you'll go over. But those are things that you really need to have it locked down before you make your first offer.
Well, that makes sense. So, because Bruce has not joined us yet, I'll just take over his portion of.
I got a quick question for Peter.
Sure.
Peter, what do you see with there's a new rule coming out about the disclosure form for the properties. You can't get out of paying, you can't pay $500 and get out of doing the disclosure now. How does that disclosure, even if somebody's coming in to, rip the place down and rip it apart, on the buy, there's that disclosure form, but then how do they offer that out on the other side when they do sell that?
So it's a great question. So you're talking about the property condition disclosure form.
Right.
And March 20th this year, it changed. It used to be you could just waive the form. The seller was supposed to fill out a questionnaire. I think it's 57 questions. And they could waive it by just giving a $500 credit.
Right.
So they can't do that anymore. So you have a couple types of sellers that are exempt. So in the estate example, they're exempt. They don't have to fill it out. But if you're working with a regular seller who's supposed to fill out the form, there's a lot of debate in the legal community right now whether it can be waived. What I've been doing is I have a DocuSign that I created. It's a template. I send it to my clients. A lot of your questions are unknown. So you can say yes, no, or unknown. And
right.
Look, let's face it, your buyer knows they're buying a fixer-upper. They're buying a property that is really just a gut reno. So even if the seller fills out the form, which I do advise my sellers to do sometimes when they're a regular seller selling to an investor, the buyer already knows they don't care. They just want the property.
Right.
So the liability is still relatively limited.
Right. And then moving forward, when they go to sell the renovation, they're documenting all the renovations that they've done and disclosing everything.
Right. So then they have to fill out a PCDS as well. You're
right.
When you flip on the other side, even if unless you're selling out of a trust, which you're not, you're selling out of a corporation, usually an LLC, you're going to have to fill out the form. So it's based on actual knowledge. You can answer unknown, yes or no, or not applicable. So the bottom line is you need to be aware that as a seller, you may have liability if you make a material misrepresentation on the form. But if you're doing a good job and you're fixing the property up and you're rehabbing what some of these problems, these clear problems are, which most people are doing because you're not going to sell a property with an obvious defect that anyone can see.
Right.
You fill out the form and you really don't have to worry about it.
Hey, Pete, do you find that there's a big difference between clients that are doing ground up construction, basically from land, as opposed to going into a home that's already built? What do you see the big differences there?
The big difference is in the type of contract. So if you're doing a ground up, you're doing a new construction contract, which means you're supposed to give the implied warranties of habitability, merchantability. There's a general obligations law warranty you're supposed to give on the condition of the property. There's a different contract. The lenders are going to require different things on your purchase side when your end user is buying the property. On the vacant land contract, when you're buying the property as the investor, you're going to have some different challenges and different clauses that we're going to add. So it's a different animal. What some of my clients have done in the past is they've tried to say, look, it's not new construction. I'm knocking down everything, but I'm keeping up one wall. That's a pretty common thing. Sometimes you can get away with that. Sometimes the FHA, if your buyer is an FHA buyer, says, well, it's really new construction. We don't like this contract. And then they make you switch back. And now you have to be prepared for that as a seller, that you may have to give the warranties that you might not have in the past.
So I find that for the new buyer who wants to do a fix and flip and wants to, build their wealth through real estate, I find that their questions, most of their questions are, well, how much money do I need? And it's really a simple formula. If you're a first time person, you're probably going to have to put 20 or 25% down of the acquisition cost. So let's just look at that. Let's pretend that we were buying a house for $300,000 and I've never done a project in my life. So they're probably going to want me to put down between $60,000 and $75,000, depending on my credit and my personal income. And then from there, you normally can finance all of the construction. So as you grow, as you get to 3 deals, maybe instead of 20 or 25, it becomes 15 to 20% down. And when you get to 10 deals and you do business with the same lender, the same funding company, the same fix and flip company, you might be able to get it as low as 10% down plus the construction. So that's one part of the financing. The second part that you have to do your homework on is the construction costs. And what we find is when you come in as a new person and you give me, hey, the construction costs are going to be 100, don't do that. You got to put in some sort of reserve, because the banks are going to give you the money based on what you told them. If you run out of money, they're not giving you any more. So if you think it's 100, you better add a $15,000, $20,000 reserve. And they understand that, and they really love to see that. So make sure that you're not trying, people look at it and they say, maybe I should tell them it's not going to be that much. No, tell them it's a little bit more. Let them cut you back a little bit.
Right.
Not, I need money at the end. When you run out of money, you run into major problems. And then finally, so step 1 is how much money do I need finding the property? Step 2 is the construction cost. Step 3 is what will the future value be? And try not to be a homeowner. When you ask a homeowner, how much is your home worth? They never come in low. I've been doing this for over 30 years. It's my house is worth more. And then they give you the story why the house next door sold for X amount of dollars, but their house is nicer because they like the paint color. And that house had ugly carpeting. We don't. No, it's not true. So make sure you have an understanding of what the future value, or ARV, is going to be after repair value, right? That's ARV. And you want to have 70% as your ARV. $300,000, $100,000 for construction, makes it $400,000. You want that thing to be worth $520,000. Right. So you have, right, or $550,000, excuse me. So there's a reason for them to make a loan to you. You have to understand, as a new person, that deals are a lot tougher than you see on TV. There are so many people looking to do this. You have to really use the elbow grease. You have to look for the person with the lawn that hasn't been cut, in 3 years. You really have to do skip tracing, which is, looking to see, who's behind on their mortgage, who's in trouble, who just got divorced. There are so many things that you need to look at. Who just died? You know, when you're looking to find a home that's going to be a fix and flip home or an investment property where there's an opportunity for you to make money quickly, those are the things that you're doing. It's not going to a listing of the hot new listing. You know, it's been on the market for a day. You're not stealing that house. You're not getting a good deal on that house. There's 50 other people who are coming behind you. Certainly foreclosures. You know, if you're speaking to realtors who work with foreclosures, but even the banks have started or are a lot wiser than they were the last time in 2007, 2008, you know, as far as giving properties away. They don't want to do that. They want to make as much as they can to get their money back. We've had a client in Queens that subdivided a property. It's a great idea. They went through 2 years. Pete, they didn't use you. You could have probably gotten it done in a year and a half. But they went through 2 years getting approval to subdivide a property. When they subdivided the property, now what did they need? They needed construction money. They found a contractor, a licensed contractor. They needed some money. Well, P.S., they told us that they were going to be done in February. It is now going on June. Not only are they not done, but they are having problems with the city allowing them to bring the water from the street to the property. And now they're paying, they've gone through their initial 6 months, and now they're paying $5,000-$6,000 a month, you know, carrying costs, and they're making their second payment in a couple of days. Well, the lender's starting to get itchy. Hey, you told me you needed the money for 2 to 4 months. We're now on month 8. And that starts some issues. There might be some penalties, you know, because they can't lend that money to somebody else. So they should have said we need the money for a year and been okay with that. But they didn't. They put in 2 to 4 months and they really hurt themselves. Pete, what can somebody do when they run into problems, you know, where they need something from the city to, you know, to get?
That's why I hire expediters. The city of New York is not easy to deal with. You need to factor in that I tell all my clients, if you are told it's going to take 3 months, figure 6, because it's just delays are common. And you're dealing with a municipality, a giant bureaucracy. And, you know, one of the problems with the city, and I don't want to scare anyone, I had this problem with a client recently, is they have a violation. The building inspector comes and looks and says, okay, fix A, B, and C, and then leaves. And then they reschedule the inspection after they fix everything. And a different building inspector shows up, not the same one that was originally assigned that saw it, and now finds different problems. And that happens. So you have to be aware of the code. You have to work with an experienced contractor, an experienced expediter. All you can do is limit liability, right? You can take your risk and boil it down to its lowest common denominator. And that's by making sure you have competent people working for you who know the geographic location in which you're building.
And as far as getting a final CO, so if you're doing a fix and hold instead of a fix and flip, or even a fix and a sale, you know, you need to have a final CO from the city or from, you know, the town in Long Island. Is there an average on Long Island to get a final CO versus the city?
So it's going to take less. Look, Long Island is different because it's a different little fiefdoms, right? You have town of Hempstead, town of Oyster Bay, in Nassau County. You have all sorts of different towns, town of Brookhaven, Islip. I mean, everything is its own town. Then you have you have a village oftentimes. So you have so many different layers of bureaucracy on Long Island. It's generally going to be quicker just because it is on Long Island, but you're dealing with several municipalities oftentimes as opposed to one. So I can't give you a definitive answer only because it depends on where you're building.
Okay. And then that brings us to the potential fix and flip market and the profits. If your dream is that you want to make $200,000 on every deal, don't bother. Because with the amount of folks that have come in, there's compression on the profits. Now, would it be, you make $100,000 a year, would it be so terrible that in 4 months or 5 months, you made $30,000? Would that be such a bad thing that you made $25,000, $30,000, $35,000 on a deal? No, those are the average profits that you're seeing. If you hit something, 75, 100, 150, $200,000, that's a grand slam. Those are few and far between these days. It really is. So, when you're seeing the profits that your clients are making these days, I'm not talking about, homeowners. I'm talking about people who are doing the fix and flips and now they're selling it. Is there, any profit margin that you've noticed? Anything
Well, I'll
that you've
tell you,
noticed?
the range that my clients like to be in is a minimum of $50,000 profit. 50 to 75,000 is their comfort zone. Most of them, they want to know that they can make that. So they'll build in extra, just like you were saying before, to make sure that they understand the numbers. And that's why lenders will generally lend better terms to experienced contractors and experienced people that fix and flip. So if you're going to do it, you want to do as many as possible and do them successfully, and you're going to get much better terms and your profit margin is going to go up. The other thing a lot of my clients do is they spread out their liability by having partners. So they'll do an LLC, a limited liability company, and they'll have multiple partners who will invest, and they'll have terms as to how those partners are getting paid, whether it be a percentage of the profit itself or whether it be paying them interest. But they have different members, so they structure it in a way that they can spread out some liability.
Peter, have you seen any nightmares in the last year or two from people who started construction and for whatever reason they didn't finish the construction, the fix and flip, or they couldn't get the price that they were, looking at?
Yes. I mean, look, it happens. People try to get out some. You're not going to win every deal, right? It's just not. That's not life. You're going to make investments based on your experience, but based on the numbers, but sometimes they don't work the way you think they're going to, and life happens. I see times where there's a violation on a property. I had a file just recently. The seller didn't have a certificate of occupancy for a second story that went back before that seller even owned the property, and it was caught on a survey by the buyer after the investor had done all the work to rehab it, and nobody ever checked the COs. Nobody really thought about it, and now all of a sudden they have to go back and get architectural drawings.
So that's why they need somebody like you, because you're going to do that before they purchase the property.
We're going to do that. We're going to discuss it. I interview my clients beforehand. I find out what they're doing, why they're doing it, and then we have a discussion as to what some of the potential pitfalls are. So they have a checklist of some of the things to look out for on the legal side. I mean, other things you see, violations are an obvious one, but a lot of people just don't really think about the fact that there's a violation that's going to have to be resolved, and that's going to take extra time. There are all sorts of hidden issues if you don't have experienced people. That's why you can make up for your lack of experience by having a good team around you. But if everyone on your team is inexperienced,
absolutely,
you're asking for trouble.
And it's interesting, Pete. If we do 20 fix and flips for newbies, I would say 15 of them never do another deal. And they never do another deal because they were so stubborn and they know it all. And they're a contractor, or they're this, and I know this and I know that. Well, there's a lot of other things. There are, so many different, lanes that they have to be taken care of, that just because you're a contractor doesn't guarantee you the profit. So putting your legal team, putting your finance team, it's not about, you're charging me X percentage versus Y percentage. It's about, hey, when do I get the money? Because I don't know if you're aware of this, folks, but the money doesn't come to you all in one check, and then you get to use it as you need it, and it's in your bank account. What we do, let's say it's a $150,000 job, we might divide it up into 4 or 5 different payments. So you call me and you say, Todd, I'm done with section 1. Well, we're going to get out there right away. But I know other banks, that get out there. It might take them 10 days to get out there. Now you're sitting there losing money every single day because somebody didn't get out there for 10 days and you didn't get your second set. Now you're also, it's springtime, you lost your subcontractor, just went to do another job, and your whole job got thrown off. So it's more important about to use a financing company, a mortgage company that you trust, with somebody who's got a lot of experience. Now, if you look up a mortgage loan originator and they've been in the business for 2 or 3 or 4 years, I guarantee you they don't have any experience or very limited experience. Unless you have the experience, you should not be using those folks. You really should look up and say, okay, and you can look up and see how long we've been licensed. Look up and say, hey, this guy's been around 15 years. Okay. How many fix and flips have you done? Okay. Give me a couple of clients to review. It's more about having the success of the money coming to you than it is about, oh, on my 4 payments, I saved $200 each payment. That's not what drives profits and creates headaches for you. It's getting the money quickly, and it's us understanding that if a problem arises, we're going to understand it. We're not going to, break your chops on it. So that's
you're saying, don't be penny wise and pound foolish.
Yeah, I'm saying that. But you'd be surprised how many people call you up. They only want to hear what's the price, and we don't care what the experience is. We don't care about anything. And I do a lot of speaking, and I go to a lot of networking events for these, and I run into people, and they're on deal one, or I run into people working at banks, and they just came from a refinance company to a fix and flip company. They barely know what they're doing. You really have to interview everybody during the process, including the attorney, including the contractors. You should not be using the lowest bid if there's something that you don't do as a contractor per se. Okay.
I would say that it's all about putting the proper team together. And I thank you, Todd, for bringing us Peter. And I think this was a great conversation. And I think, Peter, you're always welcome back. But I think it was a great show, Todd. Thank you very much.
Okay.
I appreciate
we'll see you again next Wednesday on Mortgage Matters. And we'll have 2 more people going to be talking about commercial properties and commercial financing next week.
See you then. Thank you, gentlemen.
Thanks, everyone.